Okay, so let's do 18-10, exercise 18-10. This is on page number 1036. Okay, so this problem is about allocating transaction price. So that's we talked about it. Remember, we are going through the revenue recognition policy. Okay, so here we are going to carefully look at what are the obligations that have been generated, and only recognizing revenue when the performance obligations are completed. And before we do that, we have to make sure that whatever the transaction price is of that contract, there may be different performance obligations, so we have to allocate that transaction price to our three performance obligations. So in this case, Jarrett's Windows manufactures and sells custom storm windows for 3-season porches. Jarrett's also provides installation service for the windows. The installation process does not involve changes in the windows, so this service can be performed by other vendors. Jarrett's enter into the following contract on July 1st with a local homeowner. So the first three sentences basically clarifies that it's offering two. One is the windows. So there are two obligations. Windows. The other one is installation service. And from those sentences, it's very clear that these services can be performed independently. Okay, they don't depend on each other. So these are two separate obligations under that contract. So that means whatever the total transaction price that we have determined for the contract, we have to allocate it, okay, to these two performance obligations. That's what the main task is in this question. So let's talk further. Jarrett's entered into the following contract on July 1st with a local homeowner. The customer purchases windows for a price of $2,400 and chooses Jarrett's to do the installation. So $2,400 is what the transaction price is for this contract, which has two performance obligations. Now reading further, it says that the Jarrett's charges the same price for the windows irrespective of whether it does the installation or not. So basically this is a kind of a marketing scheme, right? So you have a certain price to a customer and you offer them installation or not installation, but whatever, both you pick that, you are going to be charged $2,400. So it's kind of a bundled together price, okay, for these two services. So now the question is, what does it say later? So let's read further. Jarrett's so it says the installation service is estimated to have a standalone selling price of $600. So now in order to allocate, we need to have a standalone price for each of those performance obligations. Okay, so that's the main idea behind these questions. What's a standalone for installation? It's $600, and then it says the customer pays Jarrett's $2,000, which equals the standalone price of the windows. So this is for installation. For windows, it's $2,000. These are standalone prices. Okay, for windows. Windows. So now, in order to allocate, but the combined price for these two services is $2,400. This is kind of a fruit, price with a sort of a sweetener involved, right? So we'll charge you $2,400. We'll give you installation. We'll give you $2,000, so that you don't go to different to other vendors. So this is kind of an attractive price. So then in that case, now you're going to be allocating the standalone $600, divide that by $2,600, which is the sum of the standalone for both the obligations, because that gives you a good allocation, sort of a proportion, right, percentage, and multiply that by $2,400, which is your transaction price. Do the same $2,000 divided by $2,600 multiplied by 2,400. This will give you the allocation for installation, and this will give you the allocation of transfer price for the windows. So this, I think, is the answer to the first one is 554, approximately $1,846. So once you have these two numbers, that means once the work is done, that's what we're gonna recognize out of $2,400. If you sum these two numbers up, it's going to be $2,400. So we will recognize revenue when the work is done for installation and for windows by these two amounts. So that's what we know now. Now comes the next information, is that the cost of these windows is 1,100, so that will be used for the journal entry. So the customer pays direct $2,000 upon delivery, and the remaining balance upon installation. So payment will be done on 2 dates. So let's go into the first date. The windows are delivered on September 1st. So comes September 1st. What are we going to do? We know we are going to get cash for $2,000. So get cash $2,000. Okay, debit. And according to the contract, we are once the work is done, right? Once the obligation, one of the party does something, right? That's where we recognize things. Financial positions change. So we will recognize accounts receivable for the rest of the $400, and we have the revenue for the work. Revenue for at this point $1,800, right? $1,846, because you have delivered the windows. Now, of course, you have still an obligation which is unearned revenue. Obligation that is in the future according to the contract, which is $554. $554. So this thing represents this contract, okay? That you have. You're now in a contract where you're recognized this contract in the financial position by taking the relevant assets and the liability. So asset liability approach, right? And recognizing the obligation when the work is done. So we have done that work. So this should take care of that. And then comes the October 15th. On October 15th, again, we are now cash is going to come in for $400, and accounts receivable is going to be credit for $400, right? So we're just changing those two assets, right? It's just an exchange, and then the obligation is done, is satisfied. So unearned revenue is 554 debit, and revenue is 554 credit, right? So here, what overall I'm gonna say, what we look when we look at this question in the beginning, we know this is the transaction price of the contract. Under that contract, there are two obligations. That means now we have to think about those two performance obligations. What is the standalone price? Because we need to, this big contract price, transaction price has to be allocated for the two different performance obligations, because when the work is going to be done for these performance obligations, that's when we recognize the revenue. So we do that allocation, right, based on their standalone prices. So we allocate the transaction price based on that. When one obligation is done, we recognize that revenue for 1846. We recognize the asset liability for this contract at this point, and we also once we don't do the second performance obligation.